Hey folks, Peter Richon with Richon Planning here. I get a lot of questions, and I get a specific question very often of how should I start investing? And in fact, not just how, but when should I start investing? Where should I start investing? And then how do I go about that process? Well, that's what this video is going to be about. You know, the secret to investing is as much as possible, as early as possible, and as often as possible. And that's what's going to bring long-term investment success. Just doing it as early as you can, as much as you can, and on a very regular basis. But you do need to have a few things figured out to begin that process. Number one, you should always build any structure on a solid foundation. And investing is no different. You're building your investment portfolio, but you have to have a solid foundation to give the investments the best possible chances of long-term success. So what does that foundation consist of? Well, as you may know, I am a Dave Ramsey SmartVestor Pro, and as far as I am aware, there is no other written, documented financial system that has gotten more people out of debt, building wealth, that's what we're talking about here, and eventually achieving millionaire status than Dave Ramsey's baby steps. The foundation of the baby steps are baby steps 1 through 3, and in fact, a couple pre-baby steps. The pre-baby steps are that any mature, responsible adult over the age of 18, if you've got a spouse, if you've got a mortgage, if you've got children especially, you should have your legal documents in place. And in case the worst possible scenario is to happen, that your wishes have been documented and are in place. And that is either death, or if you are incapacitated and appointing somebody legally to make decisions for you. The second, again covering worst possible scenarios here, is that you've got life insurance in place. Good term life insurance to protect your family, to pay off those debts, to replace your income is essential. And it's essential to your investment and your family's investment success to have those protections in place. Then we get into the actual baby steps. So the foundation here, again, baby steps 1 through 3, you want to get through these as quickly as possible, as intense as possible. And that is baby step number 1, that you have $1,000 in the bank. Baby step number 2 is that you pay off all of your debts, smallest to largest, except for the mortgage. We're going to put a mortgage on the back burner for the moment. But line up all of your debts, credit cards, automobiles, student loans, medical bills, and order them smallest to largest. Don't worry about investing yet, because the interest rate working against you on those debts is guaranteed, and in many cases probably higher than you can expect if you were to begin investing those dollars. So if somebody comes in and they've got $20,000 in debt and they say, hey, I've got $20,000 in cash, where should I invest it? Usually my advice is, well, let's knock those debts out, because that's your best guaranteed investment, and return on those dollars is to not have that debt working against you. Then baby step number 3 is have a fully funded emergency account. 3 to 6 months worth of living expenses in the bank, waiting for emergencies or life to happen, because if you can just pay for an event when it comes up, it really isn't an emergency, it's more of an inconvenience. But that foundation, having that there, is what's going to allow your investments moving forward the best opportunity for success, because if life happens with dollar signs and an expensive emergency comes up, you don't have to derail your investment portfolio to deal with that issue. You've got your emergency account there. So now we're on baby step 4, and that is invest 15% of gross household income toward retirement accounts somewhere. Now, somewhere is a little bit generic, so where should you invest? There is a bit of a hierarchy of better to good to it gets done. So number 1, if you have a match on your 401k, that is the top utmost place to invest your dollars, because there is nowhere else in the financial world that you can guarantee yourself the kind of immediate return that a match offers you. And it doesn't matter if it's dollar per dollar or 50 cents on the dollar or 25 cents on the dollar. if you put $1 away and $1.25 shows up in the account, or if you put $1 away and $2 shows up in the account, that is an immediate guaranteed return that you can't get anywhere else. So no matter what, if there's a match on the 401k, first and foremost, that's where you begin your investing hierarchy. After you've maxed out the match, it may make sense, and typically does, to pivot out and invest in a Roth IRA, especially if your 401k does not offer a Roth option. Now, most do these days, but some still don't. So you would pivot outside of the 401k and create and fund a Roth IRA. If you've maxed that out, which in 2024, if you're under 50 years old, that is $7,000 per year. If you're over 50, you get an extra $1,000 for catch-up. But if you've maxed that out, then you pivot back to your 401k and continue funding till you get up to that 15%. And it doesn't matter in the 401k if it's only traditional and does not have a Roth component. If it has a Roth component, perhaps even better, but you really need to check kind of your income and therefore tax status, your tax rates, your tax bracket, and then your projected tax rate and bracket in retirement to make sure that that is the right decision. But I certainly feel there's a huge benefit to Roth savings when and where possible. So again, the hierarchy: match on a 401k, Roth IRA, and then back to the 401k. It doesn't matter if it's Roth or traditional, but Roth is probably the preferable of the two. Then you have to choose an institution. Now, in your 401k, your company's already done that for you, right? You have a company-sponsored plan. You are participating in their plan. They've chosen the institution that that plan is housed at. But for your Roth IRA or your IRA, or even if you're doing your 15% in retirement and you still have available money and you just want to invest it for any reason, any purpose, outside of retirement savings, a non-qualified individual or joint account, you still have to choose an institution regardless. And there are many of them out there. I'm not going to specifically endorse any of them in particular, but there are many good ones, and these days access to those institutions and creating accounts there is very inexpensive. There is very low cost. In fact, these institutions, they want you to open accounts with them, so they generally make that very easy. You go to any of them, they're many big name institutions, and click the button to open an account. You fill in some information. They'll make it easy, guide you through it, and make sure that you can open an account. Then what's good is kind of linking your bank account to it so you can make regular, recurring, ongoing, and automatic contributions, or one-off on-demand contributions. That's a great way to go about it. But if you know that your payday is the 1st and 15th, maybe you want to set up those contributions for that excess money on the 3rd and the 17th, for instance. And what I've seen is that people forget this important step, and instead, they know they have their paycheck coming in, and they know that each paycheck represents more than their monthly bills. And so extra money, surplus, has been building up in their bank account, their savings account, their checking account, much more than that baby step 3 emergency account would indicate. Remember, 3 to 6 months worth of living expenses is what you want in the bank. And much above 6 months worth of living expenses, you are probably over saving, and those dollars are losing money safely. So this is where we really need to have a change in perspective and a change in mentality, a change in psychology from a saver's psychology to becoming comfortable being an investor, and an investor's psychology where every time you get paid, some of your money is going toward those investments, and specifically for retirement. Now, what to invest in is a big question that actually holds people up. Like, I'm not comfortable with the financial world. I don't know exactly what to invest in, and so they don't. Let's get over that. Look, it doesn't have to be real complicated, especially as you're just getting going. Access to the market rather than picking winners in the market is much more important. Again, investing on a regular basis and putting money away, that act is going to be more important than picking a particular stock or fund specifically. In fact, what I have found is getting going, a great way to do that is just invest in the market as a whole. And almost every institution has some version or variation. In fact, many of them have several versions of an index fund or a mutual fund that represents the returns of the S&P 500 or some other very prominent stock market index. And so that gives you access to the market in one investment, diversification with one investment, and can simplify the process in deciding what to invest in, especially as you're getting going. Now, if you build up a balance and you get a significant amount in there, maybe then there becomes more importance on a little bit of diversification and rebalancing. But today's video, again, is the question of where do I start investing? Where, how, and what do I invest in? Keep it very simple, right? The old KISS acronym. Keep it simple. So investing is a practice that for your long-term financial growth, financial progress, and ultimately your lifestyle confidence one day down the road, you have to get into the habit and routine of. And so hopefully this video is helpful in outlining when, where, how, and what potentially to invest in. If you've got any questions about getting going, I am happy to talk them through with you and help in any way that I can. Again, I am Peter Richon with Richon Planning. Feel free to give me a call, 919-300-5886, 919-300-5886. We help people formalize their plans all the way from basics to very advanced and create and craft that optimized retirement plan for you wherever you're at in your financial progress. Give us a call, 919-300-5886. Hope this was helpful. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k, or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookzone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.